All right, how's it going, you guys? I'm super excited to get this channel kicked off. I have a podcast. I will link in the description. My name is Tanner, and this is going to be my options trading extravaganza adventure. It's going to be sweet. I'm going to share with you everything that I have been doing and everything that I've learned up until this point. I am an amateur, but I think it's important to have resources like this by amateurs so you can compare yourself, to something. So you don't have to have all these people out here who, are claiming to be professionals that will change your life and stuff. Most of that stuff is fake. But what I'm going to show you here is completely real, and I'm super excited about it. Let me know what you guys think. There will be tons more videos after this, and let's get into it. So here I have Tesla pulled up. This is my Robinhood, obviously. So Tesla, as we all know, is a monster. They've been around for a little while now. They are taking the EV world by storm. They have been for a while. As you can see, their gains this year have been astronomical. 800% returns over the year. Obviously, they were at $66 a share earlier this year. That was before the split. But what I want to talk to you today is about the easiest way to make money consistently in the stock market, playing options. Now, I'm not just talking about your regular calls and puts that everyone's talking about nowadays. They tell you to put 80% in on a call or put, and they tell you to hedge the other 20% and pray that you make money. And if you don't, sell early, or it's going to take you a long time to get that profit back. And it's absolutely correct. It's too risky. They say it's too easy for new traders. I've lost all my money before trading just plain old calls and puts. It happens to everyone at some point. And then that person who loses that money sits back and wonders how they could actually make it work for them. Well, here it is, folks. This is how you can do it. Find a company that kills it. Tesla, they kill it. I don't think that they're going to go below $500 a share within a few weeks. I would say that's a pretty fair judgment. I would also say that most people are probably going to agree with me that that is a fair judgment. So let's select a date that's about 2 weeks out, December 18th, a little less than 2 weeks. Perfect, right? So here we could see all of our calls and puts. Now, obviously, the calls gained some premium today or on Friday because Tesla was up about a 1 percentage point. That's pretty, all good, all fun and games until we see what the cost of these contracts are. Obviously, if I buy a $600 call for December 18th, that is going to cost me, a good $7,000, or sorry, not $7,000, $4,000 for that contract, which is way too much for me because if Tesla banks, I could easily lose thousands of dollars off of that very quickly. And I don't want to do that. And I honestly don't want to have to hedge for a put either. I don't want to have to risk losing money on both sides. It's not fun. I don't like just playing regular calls and puts, even though they do make you a lot of money when they go your way. Instead, we're going to find a company like Tesla that's really solid. And I don't think they're going to go below $500 a share. So we're going to make a debit spread. All we have to do is set a buy call at a low price that we don't think this company is going to drop to. Then we select a sell call for a strike price above your buy call. So let's say we just want to set it one strike above our buy call. As you can see, it changes it up here to call debit spread. And that is perfect. And you can see here that it subtracts the difference between your two strikes. So the bottom is our $500 call, which is the buy, and that is a positive $106.50 times 100 shares for each contract. And it subtracts the cost of the $505 call because we are selling that. And by doing that, we are limiting the amount of profit that we can make. So instead of buying just a regular old call, we're saying we'll pay a lot less than a regular call, but we're limiting the amount of premium we can make. And that amount is going to be the difference between your two strikes. So the difference is $5 times 100 for the amount that's in a contract. That's going to be a $500 max gain. So your range is going to be 0, which would be a worthless contract, to $500. That's our range of the contract. And to buy this contract right now, you would be paying $357 for each one contract, which to some people might seem a little steep. But here's the catch. Tesla is not going to be dropping below $505 within 2 weeks. I can almost guarantee that. So you're paying $357 while only being able to gain a max of $143 because it's already way over the money. You see, if December 18th comes around and Tesla is above $505, you make $500. Or, sorry, your contract is worth $500, but you only bought it for $357. So that's a good profit, and it only took you about a week and a half to get that, just by using time to your advantage. This is why I love this strategy so much, because you can just basically bet on a stock being strong enough over a certain period of time. And you can pretty much do this at any different number and change around your, amount of risk and amount of reward that you might get. You could select it for over the share price and it's going to be consistently less expensive than if it's under the share price. So say if you really think Tesla's going to be above 600, or say above 610, you could set your buy call at 600, your sell call at 610, and you can see the difference here is 10 times 100. Your max gain is 1,000, and you're only paying $475 for this contract, and you could get 1,000 out of it in 2 weeks. So this is the difference between doing it under the share price or above the share price. You have complete control of how much risk you want to put in. And you could even go less risky too. You could go even down into the 400s or 300s. So say I don't think it's going to go below $400 a share. Let's see what the cost is for a contract at 400 and 405. As you can see, it's even less risky. So you're going to make even less profit. Here you're paying $417 for a contract, with $500 being your max contract worth. So you have a lot of control. You can pretty much decide when you want that premium to grow over what period of time. And that is truly why I love debit spreads so much. And you're going to hear me talking about these a lot because I use them a lot. And they've been my most profitable ever since I really got into trading options. And I really want people to know that this is something that they can do. And it really doesn't take a whole lot of hard work. It just takes being patient and risking, a decent amount of money for not a whole lot more profit. Usually in my debit spreads, I'm spending about 75%, maybe 60 to 75% of what a contract's max gain could be worth, just because I'm really playing it safe and I'm just waiting for the time to play into my favor. And that's what's so awesome about debit spreads. So that's going to wrap it up for this video. If you guys have any questions, please let me know in the comments. You can also hit me up on anywhere my podcasts are. That stuff will be in the description as well. I hope you guys enjoyed. Hopefully it wasn't too confusing for you. If you think you need something a little more basic, I am more than happy to upload something that explains this stuff a little better and to a better degree. And I could also even go over some of the basics. I'm really just looking forward to collaborating with people and getting into the community of this sort of thing. And I'm super stoked. I hope you guys are too. Please support the channel and the podcast. And I will see you guys next time. Thanks so much and have a great day.